Hello and welcome everyone to this weekly market recap for the week ending Thursday, March 6th, 2025. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be back with you all again this week. Sorry I couldn't make it last week, had a family medical issue, but back rolling again, looking at the market, and a lot of negativity out there, a lot of downtrends in play. We're going to talk about some of that, what it could mean as we go forward. I do see the possibility of maybe even a right side of a neckline right now in the S&P 500, which is downsloping from the left side of the neckline, so that the next bounce could form a right shoulder. Just be aware of that. From an economic perspective, we've seen a number of reports out that have been looking like the economy is weakening. Last Thursday, we had initial jobless claims out, and they came in way above expectations. But this morning, we had the opposite. The expectations were lifted based on last week's claims, and this week we came in quite a bit below the number. So it's been kind of a crazy period here in terms of trying to figure out, first of all, where the problems are, and second of all, which problems the Fed's going to try to tackle. Is it going to be what could be a weakening economy, or is the Fed still concerned about inflation? Throw in the tariffs, throw in a lot of other issues that are in the news today. And what we have is a market that obviously is a little bit nervous. With the volatility index is one of the big stories, back over 20 right now. Anytime the VIX is above 20, I always say nothing good happens when the VIX is above 20, or not a whole lot until we finally bottom. So you got to be careful. Anytime the VIX is over 20, that usually leads to more impulsive days of selling. Or days of impulsive selling, if you will. And that, is not generally does not work out well if you're on the long side, because I refer to it as a period of time when market makers go on vacation. And a lot of times that will result in key support levels, key trend lines, moving averages, and so forth. They don't seem to work when the volatility index is high, as we see a lot of indiscriminate selling across so many areas of the market. And if market makers are on vacation, they're not providing that liquidity, we can see those drops, and they can be extremely swift. So you got to be on your guard right now. I don't care if you're bullish, bearish, or whatever. When the VIX is in the 20s, the volatility can really get out of control. We can start to see really fast, big moves in both directions. So you might think, oh, it's going to go down all the time. That's not the case. A lot of times you'll get a big recovery, and then perhaps more selling ahead. So just be careful, be on alert, understand what a high volatility environment means. Looking at the action over the last week or so, you can see the Dow Jones Industrial Average down 1.75%. That's the best index we've had over the last week, and that's dropping 750 points back below 42.5. Remember, our all-time high on the Dow was up over 45,000. So we've come back down more than 5%, probably close to about 6% off of that all-time high. And what I've been looking for in Q1 is the potential, anyway, for a 10% correction. And we're well on our way there, especially on the NASDAQ. But anyway, Dow Jones down 1.75% just over the last week. Transport's down another 2% over the last week. S&P 500, NASDAQ 100, both down close to 2.25% over the last week. And then you've got S&P 400 mid cap, which is down 3%. Russell 2000 down more than 3.5%. So it has been across the board selling. Small caps continue to take the brunt of the selling, seems to be accelerating again in that area. And until we get signs of maybe some, a changed forecast by the Fed, where maybe they think about that, hey, we do need to start to cut rates again. I think at that point, maybe we see some more outperformance by small caps. But right now, given the uncertainties in the market, seems like small caps taking a little bit bigger hit than some of the other major indices. From a sector perspective, over the last week, only two sectors have been higher, both defensive sectors, healthcare, consumer staples. So if we were going down and we saw money rotating back into some of the growth areas, I'd feel a little bit better about this downtrend, but that is not happening. You can look, you can see consumer staples, the defensive area of consumer stocks, up 0.3%. Then you've got consumer discretionary, which is the more aggressive area of consumer stocks, and that group is down almost 3%. That is another huge difference in performance among the consumer stocks. And we've been seeing this for a while. And I'll show you a chart a little bit later in the show that clearly highlights how bad this relationship, staples versus discretionary, has been. And I think that's one of the culprits of the overall market. I mean, we saw that ratio start to deteriorate back at the end of January and into early February, and it wasn't until mid-February that the S&P finally rolled over and we started to see the selling. But I think those early warning signs were spot on. Talked about it. I kept saying how cautious I was. I thought a correction could be coming, and now I think we're in the middle of what some of these signals were telling us. Other aggressive areas, you can see technology down 3%. Financials, which they were poised to perform well when rates continued to move lower, and they were one of the best areas of the market the last quarter. They were the best sector in terms of earnings growth year over year. I think financial companies in the last quarter were up 56% year over year. And a lot of that was because we started moving more toward rate cuts. And we actually saw rate cuts in the fourth quarter of 2024. But since the Fed has kind of shifted back, said, hey, we're still focused on inflation, you can see now that that shift is back out of financials. And again, it's kind of like small caps. Until we start to get back into an environment where most of Wall Street feels like rate cuts are coming, I think you're going to see financial, small caps, these areas tend to underperform. So it just wasn't a good feel last week, again, in terms of sector performance, the rotation we're seeing, and the fact that 9 of the 11 groups were down. All of the aggressive groups were down. That's not a great feel. 10-year Treasury yield. Let me give you an update here where we are currently. 4.29%. We've had a nice little rally in the yield, which means treasuries are going down. Money's rotating out of treasuries right now. Be interesting to see if we can get through that 20-day moving average on the yield, though, because we are in a pretty steep decline. Last time we pushed higher, we could not get through the prior high. I think this gap resistance on the yield, I think that is going to be a difficult area to get through, and that is between about 433 and maybe 440. And today we got up to 434, backed off of it. We got the 20-day moving average right in the middle of that gap resistance zone. So that's going to be a key area to try to clear. Moving on to the S&P 500. Again, let's get a quick update here. Right now we're at 57.41. So we bounced a little bit off the lows, but we're still down 1.75% today. Not very good action. We have lost the gap support. One of the things I've been looking at here recently, if you go back and you check out using that inspect, Mr. Inspector there, you'll see that back on November 5th, which was right when the election was held, and we had the big gap up after the election, the gap up was from 57.82 and change. If you look at this low right here, 57.82.02 was the open that day. The low, 57.73. But 57.82 was gap support. It was also the open this day. So remember that number, 57.82. We come down, and this would have been back on Tuesday. We closed at 57.78. Finished 4 points below those prior two key areas of support. We took one bounce on Wednesday, and now today, where are we? We're at 57.40. So we're back down below, and it's not going to be good if we finish weak today. It's just going to add to the bearishness that's already in play. We have now seen the death cross that was not apparent last week. We hadn't done it yet, but you can see the death cross where the 20-day moving average moves down below the 50-day moving average. The PPO in negative territory and pointing lower. And what that means is that your short-term momentum is accelerating to the downside. So the bears are in control here. There's no doubt about it. And like I said, with a volatility index, let's pull that up real quick. Volatility index up now at almost 25 and climbing. The highest level was back in early August. You can remember what happened? The IWM small caps went down like 15% in about 3 days, 2 or 3 days. And that's what I'm talking about. When the VIX gets elevated and we start to see selling, sometimes it can be very, very, very rapid. And I'd say we're getting into that territory right now in the mid-20s. So you got to be careful. The thing is, major or significant bottoms can form anywhere in the 20s, 30s, or even higher. And when that bottom forms, that's a great time to get in. But if you think you're bottoming at 25 and the VIX ends up going to 35 or 40, there's going to be a lot of pain in those 15 VIX points in terms of S&P 500 losses. As the VIX gets up, the swings tend to get bigger and bigger and bigger. So when you get up to 25, if you keep going up, you will probably see the selling accelerate to the downside. So just keep that in mind as we move forward, not just today, but here over the next few weeks as we wrap up March and move into Q2. NASDAQ 100 moving down, you can see again, very similar to the S&P, except key levels have already been lost. Gap support from the election's been lost. We are trading right now down near the low of the session. So it just looks to me like the NASDAQ 100 is just ready to drop and possibly drop rapidly. Like the S&P 500, we have the death cross, the 20-day coming below the 50. PPO again, very, very bearish, accelerating momentum to the downside. All of this is not good. You hope for a bounce, at least a bounce, maybe to get us to the 20-day. And I think we'll get one of those. But when do we get it? Do we get it from another 100 points lower on the S&P 500? Another 200 points lower? Do we get it now? Tough call. I mean, short term, when you've got a lot of volatility in the market, things get very emotional and folks start to trade. Many traders will trade based on their emotions. Finally, at some point, the market goes down so much, they're going to throw in the kitchen sink. They're going to say, that's it. I can't take anymore. And it's those kinds of days with capitulation that a lot of times we'll see short-term bottoms marked. So that's something to look for. IWM, small caps, really not much better. Again, get a little update there. And actually, I don't think I updated on the NASDAQ, so we may not be at the low of the day. Let me do that again. Sorry about this. Yeah, we are still down. We are right at the low pretty much. A little bit of movement, earlier to 20,061, now at 20,095, but we're fairly close to that bottom. IWM 205.02 right now, not too far away from the Monday low. And again, all the configuration is exactly the same. No positive divergences. That wouldn't probably show up until we get a decent bounce and then another lower low. And I believe that's how this is going to set up. I think we're still in, in an ABC pattern. That's a correction, an ABC correction. And I think this is A. I don't think we've had a B yet to go back up. So I think when we do see that, it's probably going to be a temporary move to the upside. Transports just continuing to be very, very weak, which is not a good sign for the economy. So as long as, and that 15,750, remember how many times we had held that? Well, earlier this week on Monday, we broke through and we've continued moving lower. Not a good sign. IWF, IWD, this is growth versus large cap growth versus large cap value. It's a ratio, but the market does not generally do well when this is declining. Remember, mid-February is when the S&P topped, but look at when growth topped. This was a warning sign in January. Growth was already starting to roll over versus value. Wall Street, if you picture it this way, Wall Street was rotating. I don't remember anybody coming out from Wall Street and telling us that. They don't usually do that. They tell you what stocks are great to buy and so forth. But I can see it on the charts that there was a lot of money rotating away from growth and into value. And lo and behold, mid-February, we start to see the market fall. That's exactly the setup, folks, that we had back in 2021, at the end of 2021, right before a cyclical bear market. Wall Street's not going to tell us when to get out. They're going to get out, and they're going to let us fend for ourselves. They're going to tell us all how to buy. They're not going to tell us when to sell. One other chart I wanted to show you here was the XLY, XLP. I mentioned that earlier. Look at this. This is since the end of January, probably a week before January ended, maybe 10 days before. But we topped and we started rolling over again 2-3 weeks before the S&P 500 finally hit that ultimate high and started to roll over. This is again a warning sign. So it was these warning signs. It was a lot of bullish sentiment that was out there in terms of the equity only put call ratio. A lot of folks just continually buying calls. And now you see what happens. Market was too complacent, too bullish, and right now we're resetting that. All right. If you are new to EarningsBeats, you can go to our website, earningsbeats.com, click on, well, you can go down below. You can subscribe for our free newsletter. Just name, email address. It's simple as that. Hit that subscribe button. We'd love to have you. We have tens of thousands of folks that have subscribed to our free newsletter. I think it's a great way to learn more about the market and maybe get used to what we do at EarningsBeats. And speaking of getting used to what we do, we are going to have next week a free education week. We're planning to have 4 events next week. They are free, F-R-E-E, free. So you want to check them out. Make sure you click on this. That will bring you to this landing page where you can put your name and email address and register. That's all it's for, is just to register for this event. So it won't hurt if you're a member, or even if you're already an EB Digest subscriber. Come in, put your name and email address in here and register. We'll be sending out room instructions to those that register, so make sure that you are. Throughout the week, next week, though, we are going to be looking at ways to trade. Right now, I think it's, I think it's a wait kind of a market, wait and see. I'm not really suggesting that we start buying stocks here. I think that there's still potentially some more downside. But what this week will do is get a lot of folks prepared. We're going to go through all of our watch list, which we call our chart list at Stockcharts, and all the research that we do. We're going to show you exactly how we put these together, what they mean, how we trade them. It's going to be very, very educational in nature. If you've wanted to learn more about how we do things at EarningsBeats, these events are going to be absolutely critical to understanding that. So if you're on your mobile phone, or mobile device, you can go ahead and click or scan on that QR code. That will take you to this landing page that I talked about, where you can sign up with your name and email address. All right, I want to go over a few stocks here real quick, just to show you what I think are some of the key names to watch, or some of the key charts that you really need to watch. Because if these break down, I think that that's only going to lead to more accelerated selling down the road. First one I want to show you is Microsoft. First, let me give you the good news. AD line remains very strong, accumulation distribution. And this means that as Microsoft's been going down, there's still been a lot of intraday buying that's been holding the AD line up. So that makes me think this is temporary. Now, we have been, we broke out above 380. We just recently went down to 380. We got close to 380 in the last several months. But that to me is a key level. 380 is the very first major support level on Microsoft. You've got to keep that in your mind and think about it. The next one I want to show you is the bank index. Banks, when the banks are healthy, that's usually good for the stock market. We want to be careful here now, because we've come back down all the way to a key support level around 635. It's starting to look a little bit like a head and shoulder pattern. This could be the right side of a neckline, so that when we do have that B bounce in the ABC pattern, we could establish a right shoulder in the banks. And then if we go back down and fail to hold, we're going to have a measurement of about 100 points below 635 on the financial. So this is a chart to definitely keep a close eye on. The third one and final one is the internet group. Very aggressive group. You can see we had tops coming across here over multiple periods at about 4,800. We broke through. You can see the volume accelerated in December as we made that breakthrough, went all the way up to 5,600, and now we've worked our way back, and we've had a couple of intraday moves below 4,800, but we haven't closed there. The question now is, are we going to close there? If we do, again, this is another really big breakdown in the market that I would not be overlooking. The more breakdowns, the more bearish it gets, the more difficult the bulls are going to have trying to straighten this thing out. So we want to watch these 3 charts very, very, very closely. I'm going to show you one feature that on Stockcharts. And if we go in and we look at, actually, let me take you in from the start here. So if you're a member, you got your dashboard up, And unfortunately, non-members can't do this. So this is a great reason to take out a 30-day trial and subscribe, especially during these trying times that we have in the market right now. But if you're on your dashboard after you've signed up, you can go down here to your alerts. And if you don't see your alerts, go in here and click on this gear shift and make sure that scans and alerts are checked. So if they're checked, you can go down. We're going to view all. I've already got one that I'm watching right now. I've been watching for a while, which was Cloudflare NET, because I think 132 level is a pretty key support area. You can see when I hover over here in that little chart, we're getting close to 132 right now. Last price 132.37. But what I wanted to show you and what you can do is click on this new, and we can just type in Microsoft MSFT. We're interested if it closes below what? 380. And then all you have to do is type in or check off the box of the notification type. If you just want to get it through email, you can do this. I don't want to get an email. I want site notification, and I want a text message. So hit that. My alert's saved. Now I don't have to keep watching Microsoft. It's going to come out. It's going to tell me I'm going to get a text message, and I'm going to see it on the website. It'll be something that'll come across the top like a little banner. And there you go. So this is a great feature that can save you a lot of time. You don't forget things. You know, if you see something, you're like, oh, I really want to be notified if it does this or it does that. That's what this alert part of this platform does for you. So make sure you check that out. Anyhow, that's it for me. I really appreciate everybody coming in. If you don't mind, click that like button down below and subscribe to the Stockcharts channel. I'm sure Stockcharts would certainly appreciate that in building their community on YouTube here. And that's it for me for this week. So I'll be back next week. We'll see where the market's going, evaluate it again, and go from there. Happy trading, everybody.